In 2003, Warren Buffett famously described derivatives as financial weapons of mass destruction. At the time, few understood the gravity of that statement, but history has a way of proving visionaries right. In 2008, the global economy nearly collapsed because of a $60 trillion derivatives market. Banks were overleveraged, financial institutions crumbled, and governments were forced to inject $29 trillion to prevent total devastation. Today, the derivatives market has grown tenfold, reaching an astonishing $600 trillion. The potential consequences of a failure on this scale are almost unimaginable. When this market eventually explodes, and it inevitably will, there simply won't be enough money in the world to stop it. Derivatives are financial contracts whose value derives from underlying assets. These can be bets on interest rates, credit risk, currencies, commodities, or even other derivatives. They are designed to hedge risk, but in reality, they amplify it. Leverage in derivatives. Markets can reach ratios of 100 to 1 or even higher, meaning that a small change in the underlying asset can create catastrophic losses. The $600 trillion notional value of derivatives is roughly 6 times the total global GDP, an inconceivable level of exposure for any financial system. To understand the danger, it is essential to look back at 2008. Lehman Brothers, one of the largest investment banks, had $35 trillion in derivatives on its books. When the housing bubble collapsed, the interconnected nature of these contracts caused a domino effect, spreading losses across the global financial system. Meanwhile, AIG had written $500 billion in credit default swaps, insurance-like contracts against debt defaults. When losses mounted, taxpayers were forced to bail out the company to the tune of $180 billion. The total global bailout, including governments and central banks, reached $29 trillion, an amount larger than the GDP of most countries combined. The lesson from 2008 is clear. Derivatives can transform financial risk into a systemic catastrophe. The situation today is far more alarming. In 2008, the derivatives market was $60 trillion. Today, it stands at $600 trillion, 10 times larger. Interest rate derivatives alone account for over $500 trillion, with the Federal Reserve having raised interest rates from near zero to over 5% in the span of just a few years, the fastest increase in 4 decades. These positions are under immense stress. Credit derivatives tied to corporate debt account for $50 trillion and defaults are looming. Currency derivatives total $100 trillion, a risky exposure as the US dollar gradually loses some of its reserve currency status. Perhaps most concerning are derivatives on derivatives, options on swaps, layered leverage, and complex contracts that are nearly impossible to fully understand or value. This enormous market is concentrated in just a handful of institutions. 4 major banks, JPMorgan, Chase, Citibank, Bank of America, and Goldman Sachs, together hold nearly $186 trillion in derivatives, almost twice the size of the global economy. JPMorgan Chase alone has $54 trillion on its books, with total capital of just $300 billion. That means the bank is leveraged 180 to -1. A mere 1% movement in the wrong direction would wipe out its capital entirely. Citibank, with $48 trillion in derivatives and $200 billion in capital, faces similar exposure. Bank of America, with $37 trillion, and Goldman Sachs, with $47 trillion, are also dangerously overleveraged, with Goldman reporting leverage ratios as high as 400 to 1. The triggers that could ignite the next derivatives crisis are already visible. First, interest rate volatility poses a massive threat. With $500 trillion in derivatives tied to interest rates, even minor shifts can create losses measured in trillions. Banks are currently able to hide these losses through accounting rules, but recent collapses of regional banks like Silicon Valley Bank and Signature Bank in 2023 have already shown how fragile the system is. Second, commercial real estate presents another ticking time bomb. Over $2 trillion in commercial mortgages will need refinancing in 2025 to 2026. Many of these loans were financed at historically low rates of around 3%, but refinancing at current rates of 7 to 9% will be impossible for many property owners. Defaults are expected to surge, and credit default swaps written on commercial mortgage-backed securities will trigger massive derivative payouts. The $600 billion CMBS market alone could generate tens of billions in losses. Third, European banks remain a significant source of systemic risk. The collapse of Credit Suisse in March 2023, absorbed by UBS, was a stark warning. Deutsche Bank, with more than $40 trillion in derivatives, has seen its credit default swap spread spike. Any major European bank failure could transmit losses across the Atlantic, creating a chain reaction among US institutions. Derivatives, by design, create a tightly interconnected global financial network. One failure anywhere can become a global catastrophe. Fourth, sovereign debt crises could serve as a trigger. Japan, with a debt-to-GDP ratio exceeding 260%, is the most indebted developed nation. If investors lose confidence or the Bank of Japan raises interest rates, the yen could collapse, generating losses through derivatives exposure to Japanese government bonds. China also represents a major risk, with $13 trillion in local government debt and a real estate sector in collapse. Defaults by major developers such as Evergrande and Country Garden are already rippling through the financial system, potentially setting the stage for larger derivative losses. Fifth, geopolitical shocks can instantly destabilize markets. A military conflict between China and Taiwan could halt semiconductor production, while escalation in Ukraine could drive energy prices even higher. Middle East conflicts could send oil prices surging to $200 per barrel. Each of these scenarios could trigger violent market movements, wiping out derivative positions in an instant. Derivatives are designed to hedge risk, but they also concentrate it, making markets more fragile than ever. History provides sobering lessons. The 1929 stock market crash wiped out personal wealth and triggered a global depression. The 2008 financial crisis required trillions in bailouts to stabilize the system. Yet the $600 trillion derivatives market today dwarfs both events in scale. The combination of extreme leverage, concentration in a few banks, exposure to multiple asset classes, and global interconnections creates an unprecedented level of systemic risk. When this market eventually collapses, it will make 2008 look minor by comparison. What makes this situation particularly dangerous is opacity. Unlike traditional investments, derivatives are complex, often over-the-counter contracts that are not publicly reported in full detail. Regulators and even sophisticated investors may not fully understand the size and distribution of risk. This invisibility allows systemic vulnerabilities to grow quietly, only becoming visible once the system is already under strain. By the time losses are apparent, it may already be too late to act. Investors and policymakers alike need to understand that the next financial crisis is not a question of if but when. With interest rate volatility, commercial real estate defaults, European bank exposure, sovereign debt crises, and geopolitical instability all converging, the stage is set for a catastrophe far larger than anything the world has seen in the past century. The sheer size of the derivatives market ensures that no government, central bank, or private institution will have the resources to contain the damage. Despite these risks, the derivatives market continues to grow, driven by the pursuit of higher returns and the illusion of hedged risk. Financial Institutions benefit from enormous profits in calm markets, while society bears the burden of systemic exposure when conditions turn adverse. Leverage multiplies gains but also multiplies losses, and the interconnectedness of global finance ensures that losses are not isolated. They cascade through the system, impacting banks, corporations, governments, and individuals alike. Understanding derivatives and their potential impact is critical. These contracts are not inherently evil. They serve legitimate purposes such as risk management and hedging. However, when they are used excessively and without transparency, they become instruments of systemic vulnerability. The current scale of the market, coupled with extreme leverage and concentration in a few institutions, creates a scenario where a relatively small trigger could generate outsized consequences. Looking ahead to 2025 and 2026, several indicators suggest that the financial system may be approaching such a trigger. Interest rates have risen faster than in any comparable period in recent history. Commercial real estate defaults are poised to accelerate. European banks remain under strain, and sovereign debt vulnerabilities persist in major economies. Meanwhile, geopolitical uncertainty continues to loom, with potential shocks capable of sending ripple effects across global markets. Each of these factors alone is significant, but together they form a perfect storm for a derivatives-driven financial collapse. In conclusion, the $600 trillion derivatives market represents the most dangerous financial exposure in history. It is a ticking time bomb, hidden largely from public view, concentrated in a few major banks and linked to multiple sources of potential instability. When the next crisis hits, it will surpass the 2008 financial collapse, dwarf the Great Depression in terms of systemic impact, and challenge every tool available to central banks and governments. Understanding this market, monitoring its triggers, and preparing for potential fallout is no longer optional. It is essential for anyone seeking to navigate the modern financial world. The invisible apocalypse sits quietly on balance sheets, waiting for the spark that will set off the next global crisis.